Okay, I think everyone who is joining has joined. There's no more, there's no more tech delays. All right, so once again, welcome everyone to this evening's Singapore REITs topic. It's a very, very famous topic among all the Singaporean investors that we have. It's traditionally been the most popular topic, I would say. Right, I'm very excited this evening to actually introduce a few of the speakers on our end. Before that, I'm Jason here from Syfe's advisory team, and I'll be moderating the session this evening, right? So if we can go on to the next slide. This evening, the agenda will be a very, very straightforward one, right? So we'll talk a little bit about S-REITs and what's the current macro environment like. We have a guest speaker who will actually show us a very, I would say, technical analysis aspect and a very useful one. And then we'll head back to in terms of how to actually do the actual investment into S-REITs itself, right? And of course, the Q&A aspect at the end of it as well. Right. So, without further ado, let me introduce the speakers of this evening. First up, we have Ritesh from Syfe. Ritesh, maybe you want to share a few words to our audience here this evening?
Hey, Jason, thanks for the introductions and sharing the agenda. Hi, everyone. Thanks for joining in today. REITs is, as Jason mentioned, a super popular topic amongst all of us here in Singapore. So I'm very excited to share with all of you where REITs are in the current market cycle and where it could go potentially as we move forward. So very excited. Look forward to the session.
All right. Thanks a lot, Ritesh. And next up, we have Richaard. Richaard, perhaps I can invite you to share a quick few words with our audience here tonight as well.
Hello, everyone. Thanks for coming. My name is Richaard, and I'm a co-founder of WealthEnjoy.com. Like many of you, I'm also a fellow REITs investor and retail investor. So I hope that my sharing later will be helpful to you in your REITs investing journey. Talk to you later.
All right. Thanks a lot, Ritesh and Richaard as well. All right. So without further ado, let me pass the time over to Ritesh, who will actually kick us off the first section of this evening. Ritesh, please. Oh, sorry. Can we go on to the next two slides? Before that, let me just give a quick introduction of Syfe to our new clients this evening, right? There's a percentage of us who are new to Syfe, in fact, right? So let me just go through that very quickly. All right, so Syfe, we are actually an investment platform, an all-in-one investment platform. You can actually download the mobile app and actually access all the different services that you will require as an investor. All right. Next slide, you will see this is our journey year to date. We have actually been in the business since 2019, right? And throughout this period of time, we've actually gone through a lot of significant milestones, I would say, right? Next slide, you can see that 250,000 of investors have actually trusted their investments with Syfe, right? This number is actually increasing exponentially as we speak as well. All right, so now, yes, without further ado, I'll pass it over to Ritesh. Ritesh, please. Ritesh, I think you're on mute.
Yes. Awesome. Thank you, Jason. I hope everyone can see my slide, correct? Jason, all good?
Yes, we can. All good, Ritesh.
All right. Awesome. So obviously the big question that everyone has in mind is, is this the time when S-REITs can bounce back? And we have been here before, right? So if you just see how REITs as a asset class has performed over, the long term, you can see that over the 2010 to 2020, the previous decade was phenomenal for REITs. But it's just been really, really hard investing into the REITs as an asset class over the last few years, and particularly since the COVID crash. And you can see in this particular chart that first we had the COVID crash. Then as REITs started to bounce back, we started the Fed rate hikes. So interest rates started to pick up, and that led to another downward movement on the REITs. And then again, last year, the rate started to get cut from the Federal Reserve, from the US policy standpoint, and REITs again started to look good, and it started to have that upward momentum towards the end of 2024. You can see that. But again, there was a pause, there was US elections, then there was Liberation Day. So again, a lot of build-up, but each time ending it kind of like a disappointment. So obviously the question is, will this time be different? Will this time really REITs market can, get out of this, resistance level, if you would like to say so, as Richaard will cover later on as well. But it's really stuck in this range, and when will be the time when it kind of, gets out of this range? That's the big question. And there are signs that things are looking much better. If you look at 2025, and that is the blue part of this chart, if you would want to concentrate, the blue bars are the 2025 year-to-date performance of different asset classes. And you can see that Singapore REITs has gone from negative returns to positive returns. That's number one. The other interesting thing is, obviously, Singapore as a market on the equities side, on the broader equities, has done really, really well over the last 2 years now. 2024, 24% up, and 2025, 16% up, and obviously led by the big three banks, right? So those have been the driving forces with respect to Singapore equities. But you look on the right-hand side, you look at US equities. We had a phenomenal year again last year, 30+% returns there. But this year, the returns from the US market is 3%. And I'm talking about these returns in SGD terms, right? It's very important to understand that context, because what has also changed this year is the US dollar has depreciated by 11%, right? So the rightmost part, which you can see, the US dollar depreciating by 11% has had its impact when it comes to Singapore dollar investors, because whatever returns you're generating from US dollar, if your Singapore dollar is appreciating against US dollar, you're losing out on those gains. So the bar for you to invest into US dollar denominated assets has suddenly gone very high, especially if the US dollar continues to depreciate. And that's where the domestic story stands out really, really well, because number one, the broader Singapore market is doing really good. Plus, REITs are also showing signs of resurgence, as you can see in the first half of the year, 7% up there too. And what's been driving some of these upward movements? If you look at this particular chart, it compares the US 10-year Treasury yields versus the Singapore 10-year government bond yields. And while the US 10-year yields have remained kind of like constant and within, again, a narrow range, the Singapore 10-year bond yields have come off over the last few months. And that has been also partly because of the Monetary Authority of Singapore having a more easing kind of policy in the last few months as well, right? And that also then, if you translate it back to REITs as an asset class, REITs are kind of like inversely correlated to interest rates. What that means is if you look at the light blue line, that's the 10-year government bond yield. Again, the previous one, we're sharing that the government yields are coming down, right? So the light blue has been coming down of late. And you can see from previous history as well in this, Feb 24 to say, sorry, not Feb 24, but June 24 or May 24, all the way to October, you see how the interest rates were coming down, the Singapore 10-year government yields were coming down, and at the same time, the S-REIT market was going up. The dark blue line was going up. And that same thing is repeating right now as the interest rates are starting to come off on the light blue side, the dark blue is ticking up, right? So that just tells you that, depending on where interest rates are headed, we can, maybe make some, or we can probably take some view as to where REITs market is headed as well. And what is our interest rate outlook? If you look at, the two factors that drive interest rate or potential policy decisions from a Federal Reserve or the US side of things, it is basically inflation and unemployment or employment. On the inflation side, it has been a sticky inflation story so far. But the more worrying sign in the US context is the labor market weakening. The number of jobs that are created has gone down significantly in the last 2 months. And that will slowly start to dominate the conversations that the US Fed will start having when it comes to the path of interest rate. And what that means is the Fed already started on a rate cutting cycle last year, but then they paused, right? You can see on this graph, we went super high in terms of interest rate, more than 5%, and then we started cutting. But midway through the cutting cycle, it was stopped because inflation again started to ramp up a bit. So now we are back at a juncture where inflation is still sticky a little bit, We are seeing signs of, softness there as well, but, there is conflicting data too. But the employment data, which is the other factor, is really starting to worry the policymakers. And that's something that we believe will drive, the Fed decisions going forward. So if you look at September, when the Federal Reserve will meet again, there is a high probability, in fact, 85% plus probability, the Federal Reserve will cut rates, which means that if you look at 2026, we are looking at almost 1% lower in terms of interest rates, the short-term interest rates on the US side compared to where we are now. So we're definitely on a rate cutting cycle. That's very important. The second is, obviously, what does it mean for me as a Singapore dollar investor, right? Like, if interest rates are going to come down, does that mean, markets should be okay and, I can keep investing? One of the things that I mentioned previously, again, when it comes to interest rates, that also has a bearing on the US dollar. And the US dollar has been on a depreciation cycle over the last, 1 year plus. And you can see it in this chart on the right, the US dollar compared to Sing dollar. This year, it is down 6%, right? Only towards the later half, if you see from July onwards, there has been some stagnation. The downward movement kind of like, took a pause. But if you again, think of it going forward, if the Federal Reserve starts cutting interest rates, which is what we are kind of like projecting over here, then this interest rate differential between Singapore dollar and US dollar will narrow. And that basically means we are back to a US dollar depreciation cycle against Sing dollar, which again means that if you are investing in a global basis, the bar for you to generate returns in US dollar needs to be very, very high to cross the other aspect of Sing dollar appreciating against US dollar. And that again, positions us very well from a more domestic, standpoint. Number one, the interest rates are coming down, that we already covered. Number two, Sing dollar is resuming appreciation cycle, which means that if you invest in Sing dollar, you get more bang for your buck, right? Plus, at the same time, if you look at the MAS policy statement, MAS has been on a more easing cycle so far, right? They have just in the July statement said that they will now maintain the rate of appreciation for the Singapore dollar. They, again, manage the monetary policies through, a basket of currencies and how the Singapore dollar appreciates or depreciates against this, basket of currencies. So that is called SG NEAR, right? So the NEAR band is supposed to be stable at this point, which means that the Singapore dollar will continue appreciating as well, right? So again, the two aspects of number one, the domestic policy overlaid with the fact that the US dollar is going to depreciate if interest rates in US is going to come down, right? So that's two important points to, again, note. And then you do an overall pulse check on the Singapore economy. The reality is Singapore as an economy is doing really, really well. Our GDP growth is 4.3%. That's the latest release. The inflation trends are very, very subdued, right? From a Singapore context, right? Again, 0.6%. And the challenge, though, is the cash rates, right? The short-term interest rates have come off quite meaningfully in Singapore. And this we were covering earlier as well, that the Singapore, interest rates have come down while the US interest rates have remained high. And this obviously begs the question that, what are the opportunities in front of us? Because if T-bills are giving you less than 2%, that's not enough. What are the opportunities that you can, latch onto in this environment? And it comes back to, REITs, because REITs, number one, are giving you that higher yield, more than 4% above this Singapore T-bill rates, right? That's number one. And number two, from a price appreciation cycle standpoint, we may be at a point and a juncture again where REITs, from a price movement standpoint, can go back up, amidst the backdrop of the global, rate cycle reversing. And this is again, demonstrating that when you are looking at the markets after rate rising cycles, then real estate tends to do very, very well. That's the dark blue, bar, if you were to see, right? If you look at 1 quarter, 2 quarter, 4 quarters post, the Fed tightening cycle, we are now in the easing cycle. So this is where, again, REITs and real estate in general starts to do really, really well. And if you're looking to invest into real estate, there is obviously, Singapore is one of the best places for you to invest into REITs. We are one of the largest in Asia context. A lot of REITs, very well diversified. The valuations are very attractive. The distribution yields are more than 6%. Again, all of these looking super attractive. And you compare these yields against other asset classes, your STI index, which is the Singapore stock market, 5%, your MAS benchmark government 10-year bond yield, now actually close to 2%, I would say. And inflation is low, but again, the real inflation could be slightly higher. So again, if you're getting that 4% plus, uptick with your REIT investments and with potential price appreciation, that's something, worth noting. Looking at fundamentals quickly, and these are busy charts, but again, concentrate on the dark blue line on the left. The cost of debt for REITs have been increasing, but now you're seeing signs that essentially, again, if interest rates come down, which is depicted by the light blue line, which is the SORA, or the short-term interest rates in the Singapore economy, that's come down already. And the long-term interest rates are also coming down, which means that the cost of debt for REITs will also start to trickle in and go down as well. So that will be beneficial for REITs. At the same time, the average leverage or debt that Singaporean REITs are already taking, again, look at the dark blue line on the right. It's very manageable. It is, below 40%. So REITs are not over leveraged at this point at all. So fundamentally, again, looking very strong. At the same time, if you look at their valuations from a REIT standpoint, the valuation, which you measure by the price to book ratio for REITs, right now it is trading at more than one standard deviation away from the historical average. So less than 0.9. So the price to book is less than 0.9, and the average 10-year price to book ratio is 1. So we are trading below that range from a long-term perspective. And again, as I said earlier, the yield spread, the spread that you're getting above the government yields is almost 4% above. So again, very attractive from REIT standpoint. If you look at the subsector level return drivers from the REITs market as well, you look at the first half returns, very, very robust across the board, all different subsegments contributing pretty well. Whether it is hospitality from a tourism recovery standpoint, the data centers with AI and cloud adoption, these have been doing really well. Similar for industrials from a logistics, warehousing standpoint, and defensive sectors such as healthcare. But also the cyclical sectors like retail and office REITs are showing, again, signs that things are improving, right? And that kind of again brings back to the question of why REITs, right? We are obviously from a macro standpoint at a very favorable juncture to invest into REITs. But why do you also invest into REITs as an asset class is because it gives you benefits which are different than what you get from stocks and fixed income. You get your diversification, you get your tax efficiency because dividends are distributed, almost 90% or more than 90% are required to be distributed. The income that the REITs are generating, they come to you directly without tax implications. The regular payouts that you get, the fact that you're investing into real estate, but in a very liquid manner, you can come in and you can remove your REIT exposure very easily. That's again very powerful for us as retail investors to be investing in this asset class. With that, I will now hand over to Richaard to cover, I guess, why this might be the time for you to not miss the boat for investing into REITs. Richaard, over to you.
Thank you, Ritesh. Thank you very much. And everyone can see my screen? Yes, okay, good. Right. So my name is Richaard Chee. I'm a co-founder of WealthEnjoy.com. I am an avid retail investor and trader and always a student of the markets. And I also help to manage several investor and traders community in Singapore. So thank you, Syfe. Thank you, Ritesh, for inviting me to this webinar. Okay. All right. So if you'd like to follow some of the sharings that I do, please join the Wealth Enjoy Telegram channel. And this is the disclaimer. So if you need, please pause the video to read it. All right. So the last webinar we did that I did with Syfe was about 2.5 years ago, and it was on the SG banks. So did you catch the boat for the SG banks? That's an interesting question, right? So the webinar I did with Syfe back in April 2023, since then, DBS have went up in terms of total returns, that means price appreciation and dividend, went up by 94%, almost double. For OCBC, it went up by 58%. And for UOB, it went up by 37%. Now, I don't know how many of you here have attended that webinar. If you did, I hope you catch that boat. Now, how not to miss the next boat for Singapore banks? Very simple. Be prepared and watch Syfe webinars. If you'd like to rewatch the webinar that I did with Syfe on Singapore banks so that you don't miss the next Singapore bank boat, please go to WealthEnjoy's YouTube channel, click on the playlist because I have created a Syfe playlist and put the 3 webinars that I did with Syfe there so that you can easily rewatch and relearn whatever you need. Now, how not to miss the boat for Singapore REITs? Well, same thing. Be prepared because, like what Ritesh said, the boat might already be here. So I shared this slide earlier. We see that the banks have their big run since our last webinar with Syfe. But at the bottom, you will see that the IH S-REIT Leader Index, the green line, basically went negative 2%. Now, some of you may say that, wow, like that, then, no point lah. It's not doing anywhere, not doing anything. But those who can smell the opportunity, smell blood, all right, if you are a shark, so you will smell that this might be the time to really look at REITs because the boat may be here already. So let's take a look at that, right? So do you want to buy low? I guess many of us would like to buy low, right? Buy low, sell high. The question is, how do we buy low and sell high? So, well, don't learn from me, learn from Mr. Warren Buffett. So he says that you need to be greedy when others are fearful. Now, if you recall that 2.5 years ago, when we did the SG Bank's webinar with Syfe, what was the situation back then? There was a crisis. There was a bank crisis in the US. Banks collapsed in US. So that fear has spread to Singapore. But Singapore's bank have got nothing to do with that. So, but yet the Singapore banks get punished as a result of that. But because there was fear in the market, so those who took action have benefited from that crisis. Now, the Singapore's REITs currently got punished because of the phenomenal rate hike in the past couple of years. So therefore, but now the mood, the sentiments may be changing because we have a US president who is doing all kinds of things to try to press the rates down, to even firing the Fed chair. All right. And then no matter what, by the time next year, this time, the new Fed chair will be in. And, guess who is going to put that new Fed chair in place? The US President Trump, right? So surely he will not choose one that will not want to cut rates. So when the rates come down, like what Ritesh has shared, it will only benefits the REITs because the REITs is growing their business using loans and the loans will be cheaper then. So today, the segment that I would like to share with you is a simple S-REIT technical analysis method. And that is how to buy low, or I like to call it how to catch a falling knife safely. So this requires us to have patience because the technical charts that we're looking at will take many months or perhaps even several years to play out for the pattern to play out, right? So we need a lot of patience. And how do we know that the price of the S-REIT has stopped falling? Well, we look at the charts and see that visually the price have stopped falling. But I'll give you a few tips on how you can do that. And also very importantly, personally, I would like to see some signs of life coming into the price chart. So today, I'll share with you how to TA the IHS REIT Leader Index using the chart pattern, bullish divergence, and key support and resistance zones. Now, I'd like to emphasize that TA does not work 100% of the time. And if you'd like to learn about TA on your own, please visit chartschool.stockcharts.com. They have a whole encyclopedia there for you to learn about TA. Or if you like a shortcut, you can go to WealthEnjoy YouTube channel, click on playlist, click on Syfe playlist, and I did a session with Syfe regarding simple technical analysis as well several years ago. All right, so now let me share with you how to see that the price have stopped falling and how do we see that the signs of life is coming back into the price chart. So the first concept I'd like to share with you are these acronyms on the screen. They are lower high, lower low, higher low, equal high, and equal low. Basically, we will be looking at the weekly chart of the IH S-REIT Leader Index, and then we will be looking at the turning points, the major turning points on the price chart, and we will label them whenever with the acronyms that you see. So when we see that the swing high, the turning points are lower than the previous one, we will label it with a lower high. And similarly, if we see that the turning point is lower than the previous turning point, then we'll label it with LL, which is lower low. Now you will see on the right side of the chart, when we see that the turning point is of around equal height, we will label it with EH, which is equal high. And likewise, when we see that the turning point at the bottom is about the same price level as the previous low, we will label it equal low, EL, right? So it's pretty self-explanatory there. But you may notice that there is a word Trump here. Now, do you know why? That's because back in April, something happened, right? So what did he do? Not on April Fool's Day, but he did it on the day after April Fool's, and that is Liberation Day. That caused a shockwave, not just in the US market, but also in the Singapore market, including the REITs. Okay, so this kind of one-off outliers, I will not really consider them. So that's why I label it Trump. So as you can see from here, we can clearly see that using the acronyms that the price have basically stopped falling and is forming equal high and equal low. So that's how we can visually see from the price chart of any chart that the price have stopped falling. Next, I'd like to share with you about bullish divergence. Now, to share with you about bullish divergence, I need to bring in another indicator, and I'd like to bring in one of my favorite indicator, the MACD, that you see at the bottom using standard settings. So you will also see that we can also put the acronyms on the lows of the MACD, right? So when the low is lower than the previous low, we will put it as LL. And when the low is higher than the previous low, we will label it as HL, and that is higher low. And we can see on the left-hand side, the price is forming a lower low, the MACD is forming a lower low, so there is no divergence. They are going in the same direction. However, in the middle of the chart, you see that the price is forming a lower low, but the MACD is forming a higher low. So now they are not going together already, and this is what we call a divergence. So we can also see on the right-hand side of the chart, while the price is forming a equal low, the MACD is continuing to be forming a higher low, right? So this divergence is continuing until right now. So this is what I call bullish divergence, and this is what I mean by looking at the charts, and we can clearly see that the price has stopped falling and some sign of life is coming in because MACD measures the momentum and the trend of the price chart. And the fact that it's forming a higher low means that the downward momentum is diminishing. In fact, the upward momentum is kicking in more and more. All right, so that's some sign of life is coming into the price chart. So that's basically what I did. So the third TA technique that I'd like to share with you is to identify key support and resistance zones. So again, on the price chart, we look at where the price is forming a similar turning point at the top. We will draw a line or a zone across it, and we call that the resistance. The one at the top is called resistance because it's preventing the price from going up. Now, at the bottom, you will also see that I'm connecting the price turning points at the bottom using a line and a zone. And this is what we call a support because the price is being supported by this line, preventing it from going down. Again, I'd like to emphasize that the Trump episode is an outlier, a one-off event, so I'm not considering that. So this is the key resistance and support zones because they are not precise one price, it's a zone. So it's a thick line that I'm drawing across there. So why is this important? It's because it's forming a boundary to the price. And if the price breaks the resistance at the top, it tells us clearly that the price is going up and the price is bullish, right? And if the price had broke the support at the bottom, then we know that the price may be resuming a downtrend. So I hope that with these three concepts of the price pattern, the bullish divergence, and the key support resistance zone can give you a clear idea of where the S-REIT index, S-REIT leader index is standing right now. But again, I want to emphasize that the TA does not work 100% of the time. So please always do your own study about TA as well as the homework regarding the REITs industry, right? Don't forget the macro as well, as what Ritesh have shared earlier. Now that you have seen the price chart, you have learned the three techniques of using technical analysis to analyze the IH REITs leader index. Do you think that the boat for S-REIT is here already? Well, that's for you to decide. You do your own homework, apply the macro opinion that Ritesh has shared, and also the TA techniques that you have learned here today. So I hope that this sharing of how to catch a falling knife using a simple technical analysis can be helpful in your REITs investing journey. Now, at this juncture, I'd like to ask you whether you want some tips about how to invest in S-REITs. If the answer is, I assume the answer is yes. So today I'm going to share with you 5 tips. And the first tip is, how do you know when you are wrong? That means, let's say I assume that the price is not dropping anymore. I assume that it's going to go up. How do I know that I'm wrong? Very simple. Using the acronym LL, which is lower low. Now, if we see that the price chart is forming a lower low, we know that our thesis of it being bullish is negated. The second way is to see that the price have broke the key support. Now, what do I mean by that? Coming back to the chart that I shared earlier, where is the support? That's the one at the bottom, right? So right now, the price is hovering in between the resistance and the support. So in the coming weeks, because this is a weekly chart, in the coming weeks, if the price come back down and drop below, right? And if it is not due to some one-off events like what Trump did previously, then we know that the uptrend may not be here already. The boat may not have not come yet. All right. So it's very important to monitor this line now, okay, to see about whether the S-REIT leader index is resuming the uptrend or not, or the downtrend has resumed. Now, the next tip I would like to share with you is how can you invest in IH S-REIT leader index? Now, the index is not investable. However, the products that tracks the index are investable. So in Singapore, we have 2 products and only 2 that you can invest in the REIT leader index. Number 1 is the Syfe REIT Plus, which I believe Ritesh will share with you. The second one is a SRT ETF that you can search on the any broker platform, and I suggest that you search on the Syfe trade platform. The symbol is SRT, and that is an ETF that you can invest. So what's the key difference between the two? I'll leave that to Syfe to share with you. But to me, the key difference is that with Syfe REIT Plus, you can have your dividends reinvested automatically for you. Whereas with the SRT ETF, the dividends are paid out to you. Now, the next tip is how do you invest in individual REITs? Where do you even start to see what are the REITs that you can invest in? Now, if you have your favorites, go ahead. But if you are new, my suggestion is you take a look at the top 10 from the REIT Leader Index. Now, one of the easiest way to find out who are the top 10 is to go to the Syfe website, click on Discover, click on REIT Plus, and then click on Composition. Now, on the Compositions page, you click on this details word, and a window will pop up, and you can see who are the components or who are the REITs that is inside the REIT Plus, right? So these are also the components inside the REIT Leader Index. Now you can see at the top is Keppel DC REIT is currently occupying about 11% of the index of the Syfe REIT Plus. And then you also see familiar names like Ascendus REIT, CICT, MIT, MLT, and it is unpack. Okay, so you can go and check it out yourself. And this list is sorted by market cap. So by going from the top down, you can be sure that you're looking at one of the best REITs available in Singapore. Next, once you have the list of REITs to evaluate, how do you evaluate the individual REITs? Now, you can do whatever you want, but I'd like to share with you my favorite. Number one, I like to invest only in mega cap REITs. That means the biggest. Why? Because they have better bargaining power when they want to take loans or when they want to buy new properties. Second, I would like to look for resilient REITs in terms of the sector they are in, the currency they are earning from, as well as the countries that their assets, their properties are in. Now, for example, in terms of sectors, which do you think is more resilient? Healthcare or hotels? And in terms of currency, which do you think is more resilient? Singapore dollar or India rupee or Indonesia rupiah? I don't know which is which, yeah? So, but I think the choice is quite clear. And which countries currently have a stronger and more resilient rental income? Is it the US office or is it Singapore hospitals or Singapore offices? Right? So that's in terms of resilience. And lastly, my all-time favorite is that I want to see that the REIT is earning a rising DPU trend. DPU is distribution per unit. That's the dividend that you can collect. Now, what do I mean by rising DPU trend? Now, I'd like to share with you a positive example. Now, you can see that in the 17 years, almost 18 years, that this Singapore REIT have been IPO'd, we can see that the histogram is growing every single year. Isn't this very nice? When you bought a golden goose, wouldn't you like your golden goose to be laying more and more eggs every year? These golden goose have been laying increasing number of eggs in the last 17 years. However, when you compare that trend of the DPU with the price trend of this REIT, you can see that the price of this REIT have gone down, have gone up, have gone sideways, have gone up, and currently it kind of like have dropped quite significantly, right? Because of the recent interest rate. And it seems to be recovering. Okay, so regardless of the roller coaster that the price have gone through, the REIT, the golden goose, continues to lay increasing amount of eggs every single year for the last 17 years. Now, this is one of the best example of rising DPU REITs that I personally love. Now, the next tip is how do you TA the Singapore REITs? Well, you have learned something today, right? We can look at the chart pattern and we can see that the REIT that I shared with you earlier in the last 2 years, we have seen a lower low, right, in terms of the price chart. And in the MACD, we are seeing a higher low. And what is that? Bullish divergence, right? In fact, if we look now, it is both the MACD and the price chart are forming higher low. So this is sign of life. The price have stopped dropping. Okay, so please do your own homework regarding this REIT. Now, also, I have shared some TA methods with in the webinar on Singapore banks 2.5 years ago. So that exact method is also applicable to Singapore REITs. So if you have not watched that webinar, please go to WealthEnjoy YouTube, click on playlist, click on the Syfe playlist, and you can watch it there. And I may be going very fast today, not to worry. The video is recorded, the webinar is recorded, and it will be posted to Syfe YouTube as well as WealthEnjoy YouTube, so you can watch it later. Now, with that, I have shared with you how to buy low or how to catch a falling knife, as well as my 5 favorite tips on buying on how to invest into Singapore REITs. Now, lastly, I'd like to give you a bonus tip. If you're new, always be diversified. And Syfe Plus is one of the best places that you can diversify, because when you invest into Syfe Plus, you have immediately a basket of almost 20 of the best Singapore REITs, right? So if you have done that and you want to, cherry pick something, then please do your own due diligence on the individual REITs using the tips that I have shared with you today. So with that, I'd like to invite you to join my Telegram channel. It is not a chat group, so it won't be noisy, so that you can receive some of the sharings that I will make from time to time. And with that, I thank you for your time here today with me, and I'll hand the stage back to Ritesh.
Hello, Richard. Thank you so much. I think that was really insightful to hear about, how to invest into the S-REITs, how to do technical analysis. And thank you for also reminding that, look, technical analysis might not be 100% foolproof. So please do your own research while evaluating, especially if you're doing individual REITs, that can be tricky. Continuing on where Richard left, if you want to invest into REITs, there are obviously these three ways. You can invest into individual REITs, you can invest into REIT ETFs, and then you can invest through Syfe, right, from a managed portfolios standpoint. And we do have the REIT Plus portfolio. What are the benefits of buying REITs individually? Potentially, you can get higher returns if you choose the right REITs. You can have more or greater control, and you don't need to pay management fee to someone else, right? But obviously, it comes at risk, and Richard again covered it. It comes with lower diversification. So if you are new to REIT investing, please, diversify. And even if you are a seasoned investor, the best seasoned investors have also failed when it comes to individual investing into REITs. So again, it comes with very high risk, requires a lot of research. You need to self-manage and rebalance. There are also costs which are other than just the management fee. Each time you buy, sell, there is a brokerage cost involved. And plus your dividends are not reinvested. And that's like 6% plus of dividends that we are talking about. It's not small. And that reinvestment that you're not doing also erodes away returns eventually, because you don't invest, you don't get that reinvestment, showing up in returns as well. And this is where things are, right? Like, if you are picking individual REITs, these are some of the top REITs that investors individually bought in 2025. And you have the benchmark, which is the IEJ S-REIT Leaders Index, which is the index on which the Syfe REIT Plus portfolio is designed. That is up 8.5% year to date. How have these other REITs done? This is the reality, right? You hit some, you miss some, right? And you see that there are certain REITs which have negative returns. There are obviously certain REITs which have done better than the index, right? Like you have the CapitaLand Indian Trust, the Ascendus REIT, as well as Capel DC. They've done better than the REIT index. But on the balance, if you are the one who invested into Mapletree Industrial or the logistics or the recent IPO of NTT DC, this was super, super popular. You got in, you got the IPO, you're very happy, it was super oversubscribed, but then you're down 6% on that investment. So again, it comes back to the fact that if you are willing to give up a little bit of the upside with the fact that you are diversified and you're holding a basket of high quality REITs, then you can be doing much, much better with your investment. And again, you can invest into the index through an ETF. The benefits of it is obviously diversification. It is low in volatility. It gets regular rebalancing, and it saves you from all the research and time to put in. But again, there is fee associated with the ETF. So now you have to pay brokerage cost. On top of that, you have to pay ETF management fee. And on top of that, you don't get your dividends reinvested, right? So those are the cons. And this is where potentially you could take a look at the Syfe REIT Plus proposition, because here we have taken all of these aspects into consideration. We have taken into consideration that we remove the ETF management fee, we remove the brokerage costs for you, the dividends can be automatically reinvested on your behalf. And we give you access to the largest and the most tradable REITs in Singapore. So the blue chips is what we are investing into. And this is, again, done in partnership with SGX, that we use their index to get you invested into SGD-denominated, liquid, large market cap, and some mid cap, but mostly large cap REITs that you're investing. And then dividends are automatically reinvested. There is no minimum for you to come in. There is no brokerage cost involved. There is very low management fee that we charge, right? So all in one at one place. Again, the index and the REIT portfolio that we have designed is naturally diversified across different subsegments, across geographies. There is a very strict and stringent REIT selection process through which these REITs are selected, whether it is from a liquidity screening standpoint, whether it is diversification, whether it is the quality of the REITs, the manager of the REITs, etc. All of those are very carefully selected. And then if you look at the options within REITs, obviously, if you are someone who wants to optimize for dividends and long-term price appreciation, then the 100% REIT portfolio is what you should think about, because that tracks exactly the IEJ S-REITs Leaders Index. But if you are a little bit more moderately risk-averse investor, then potentially you can look at the risk with REITs with risk management portfolio, which combines the REITs with Singapore government bonds. So helps you navigate the downturns in the market a little bit better. And again, just comparing the REIT portfolio against the popular ETF in the market as well, you see it very clearly, right? Like, we are getting the same exposure, the management fee or the expense ratio is much, much lower. There is no brokerage costs. The dividend yields are very similar. And we don't pay dividends out of your, capital appreciation. If you're getting capital appreciation, that's for you to take. The dividends are purely the dividends that are given by the individual REITs, right? So we don't pay, high dividends just to, make it look good. And we take that dividend out of your capital. No, that's not correct according to us. And that's why it is paid only from the actual dividends paid by the REITs. And the distribution frequency is also much more faster. And if you think about performance as well, that's where also our REIT portfolio shines through. Whether you compare it against the IHS REIT Leaders Index or the other ETF in the market, which has all of these added additional costs kind of like embedded within the infrastructure, right? So you're looking at least 0.5 to almost like, close to 2% outperformance with the Syfe REIT Plus portfolio compared to, these other options in the market. And we have this track record, not just in, like a few years, it's been 5+ years since we have invested into REITs market, and it continues to do much, much better. Very good track record across different years. And that brings us to the last slide for today's webinar. Before I open it up to Q&A, as a thankful gesture for everyone who has, participated in today's webinar, we are giving a 3-month fee waiver for anyone who invests into REITs portfolio. And this is for both existing as well as new clients, right? So, the minimum is 5,000, but, you can go up to 50,000 and you will get 3 months of fee waived off for your REIT investment with this particular code. Also, on the brokerage side, if you are a new investor, you can get the 3 Singapore bank stocks, 1 share each, almost close to $120, that one. If you're an existing client, you just need to refer a friend. And then again, you can also get these stocks if you refer a friend. So some really good promotions out there. So please do utilize if you are looking to invest into REITs and through the REIT Plus portfolio at Syfe. Or if you're already an investor and you see this as an opportunity to top up your REIT investments, then, on top of the fact that potentially there is a price appreciation, hopefully, the fee waiver adds a little bit of that extra power as well. With that, I will now quickly pause and I'll go to the Q&A. Amanda, if you can start with the Q&A. I know we are a little bit late to it, but I will try to cover, and we will try to cover along with Richaard, as many questions as possible. All right. Everyone, please do share questions through the link that was, okay, it is back online here. So please do scan it and send your questions through. We will start looking at it from now. Okay. Let us take the first few questions and maybe I'll divide it a bit. So first question directly goes into the portfolio allocation. How much of my portfolio should be in REITs? So the way I think about REITs is I think of REITs in 2 contexts. One is if I am a growth investor, but I want a combination of growth and income, then that is where REITs, potentially can fit in a growth portfolio as part of a diversification, play. In that context, my REIT allocation will be relatively small though, because from a longer term standpoint, I would like to be as much equities exposure to drive long-term gains in my portfolio. Versus REITs, you would use it, but most of the returns in REITs are dominated by dividends, right? So it will be part of my portfolio, but it will be a very small component. When it comes to income investing, if you're someone who wants to generate passive income, or you want to build a portfolio that in future can generate you passive income, that's where I would think of REITs in a much greater proportion. In this context, I will have a larger bucket, which is bonds to begin with as a foundation, as a building block. And then I will overlay it with REITs and high dividend paying or high quality dividend paying stocks as well. What percentage in REITs? Typically, I don't recommend having more than 30 to 40% into REITs, even in an income strategy. If you are someone who is a Singapore investor and you believe in the long-term story of REITs and you don't want to take any currency risk, maybe that percentage can shift up or down accordingly. But if I were to think about investment into REITs from an income generation standpoint, it will be foundation with bonds first, overlaid with REITs, and then adding individual high quality and high dividend paying individual stocks on top of it. Richard, anything to add on that on your side? All good. Thank you. Okay, next one, Jason. Okay, why are the yields improving when the economy is not doing well? The amount of F&Bs and retail shops closing down is scary. Okay, so first and foremost, number one, the economy is doing well. The reality of operating in a country like Singapore is that not all F&Bs do well, and that's just the ground reality of all the cost structures, etc., that go into these F&B and retail establishments. So yes, there are some of these shops closing down, but the reality is if you go into malls, if you go into all these retail shop fronts, etc., you see all of them to be full, and that's the reality in terms of how the overall footfalls, etc., are in these different retail subsegments, etc. Retail as a business is, as I said, not easy, and that's reflecting in the churn that you're seeing. But when it comes to occupancy levels, like what do I care when I invest into a retail REIT? I would care about what is the occupancy level of the shops that are within the purview of a mall. What is the rental reversions that I'm getting in these establishments and all as well. And all of these, if you look at the hospitality sector of Singapore, the tourism, and all of these aspects, things are looking much, much better. And again, from the fundamental standpoint of investing into these subsegments of REITs and all, whether it is the occupancy levels, whether it is the rental reversions, etc., they're still pretty decent. So I wouldn't be too scared in that context. Yes, if there is a broader recession and a broader slowness in economies, that's where I would start to see some signs of weakness and potentially dial back a bit. But from a cyclicality standpoint, we are actually in a very good spot because inflation is low. Technically, from a core inflation standpoint, our GDP is doing really well, and overall, as I shared, the fundamentals are still pretty solid. Okay. Next one, please. Okay, this one, Richard, maybe if you can take, like the current price for REITs already priced in the potential decrease in Fed interest rates in September.
Okay, now I don't have a crystal ball, but I can share with you my opinion. Okay, so I would say that the price it is already priced in. Okay, the investors, we are not the one moving the market. The retail investors are not the one moving the market. It's the big funds that are moving the market or moving the REITs prices, right? So they have many people on their payroll to analyze everything so that they can project the future earnings or the future price movement of anything that they want. Okay, so they would have factored in the Fed rate decrease in September. Or in fact, in the subsequent quarters, based on what they know. I mean, that is also what we know, right? Because Trump has been pressuring power to drop rates, and also I'm sure the next Fed chair will be pressured, if not already, to keep dropping the rates. Okay, so with that knowledge, even I as a retail investor know, do you think that the fund managers will know? They will know, and they will know that because of that, the REITs cost of debt will drop in the coming years. It won't happen immediately, but in the coming years. With that trajectory, they will buy now because the price have dropped so much, right? Haven't gone up yet. You don't want to be catching it when it's going up. Yeah, so that's my answer.
Thank you, Richard. Okay, next one. Is there a way to set up recurring investments into the REIT portfolio with direct debit from our bank account or SRS account? Yes, absolutely. So it is in a beta phase to set up recurring investments into your REIT portfolio from a direct debit standpoint. It is coming soon. So please be patient. Yes, it will be possible. Right now, if you want to do direct debit, you can do a standing instruction from your bank into the REIT portfolio. So that's already, I'm sure you know about it as well. You can do that already. But yes, the direct debit feature is coming soon. And once we have that, yes, you can set up recurring investment directly from your bank account to the REIT portfolio. So just hold on a little bit, maybe a month away is what I would say. A much asked feature, that one. So thank you for asking. Which REITs are well positioned for growth? My answer for that would be, look, we ourselves are not active selectors of REITs. We don't, give weightage for one REIT over the other. There could be, views that I can take, which is more personal. But the way to invest into REITs obviously is, by diversifying across the different subsegments. And, again, the Syfe REIT Plus portfolio, if you think about it, encapsulates the best REITs out there in the market. So again, there could be different stories, both from fundamental and technical standpoint, that can be laid out for different REITs, why this REIT is supposed to do well against some other REIT. The reality is, like, whether it will work or not, I don't know, right? I can basically, for example, we had a previous slide where I showed the sub-segment trends within REITs. And if you think about it from these trends standpoint, obviously the data center REITs look interesting. The warehousing, the industrial REITs look very good, purely from a standpoint of the fact that so much, AI and cloud infrastructure is being, put in place, right? So those things bode pretty well for these subsegments of REITs. But at the same time, look, I mean, some of the best performing REITs are not just the industrial and the logistics REITs. I think I shared a slide earlier as well. The Mapletree Industrial and the Mapletree Logistics are down 5% year to date, right? So while again, I can give you a story for which REITs will do well, the reality is it's very hard to say. So I would again encourage you to have a diversified approach when it comes to the REITs market, and look at investment opportunities such as the Syfe REIT Plus portfolio there. Anything to add, Richaard, on that? Any
Just a
opportunity that
quick
you
one.
see?
Yeah. So I would say that it's more important to see which are the REITs that will not do well, right? So because REITs will be rotating, funds will be rotating among the different sectors, but some are clearly not doing well because of macro environments or because of behavioral changes. And some REITs will forever, okay, I won't use the word forever, but will usually do very well consistently. Okay, resilient is the word, right? So for example, healthcare, in good times or bad times, the world will need healthcare. But which are the ones that are suffering right now? They tend to be the US office sectors or anything US. So because of they haven't got out of the work from home behavior, unlike Singapore, right? Singapore boss say, you come back to office, oh, we will come, but not the US people. So the US office REITs are still suffering, hemorrhaging. So if you are the turnaround type of investor, then maybe you like to look for opportunities there. But if you are not the risk takers, then I would suggest that you look for resilient REITs, mega cap resilient REITs.
Yeah, and just to add on again, look, there are some fundamental factors that you could look at REITs, right? And you will have to do that study yourself, unfortunately, on that. One of the examples, again, that Richaard shared earlier was a prime example of, where you can look for, quality aspects within REITs, right? Like the DPU increasing on a consistent basis for 17 plus years. That just tells you that the REIT itself is managed very, very well, right? So you would, if you were to look at REITs, don't just look at it from a standpoint that, okay, because the macro environment is favorable for this segment of REITs, that's why I'll invest into this. I think you should look at it more from a fundamental and the manager selection standpoint as well. All right, next one. Please explain how well Syfe REIT Plus is doing in recent years. I think I shared about the Syfe REIT Plus portfolio earlier to everyone. Look, I think REITs as an asset class has remained within a narrow range over the last 4 to 5 years. And this is something that both Richard and I share, that it has just operated within this band, not able to break above the band, right? And each time, previously there were signs of life as well, by the way, right? Like, we saw, positive light at the end of the tunnel, but, it was a false alarm in many cases. But look, I think if you think about where rates are right now versus where rates will be 1 year from now, it is clear that the rates are down. And we saw that there is a clear correlation or inverse correlation of REITs with interest rates. So my thesis is overall, the returns from REITs as an asset class has not been that great. It is flat to slightly positive is what I would characterize. The Syfe REIT Plus portfolio, on the other hand, has actually done better than the broader benchmarks. So again, at least 1 to 2% above the benchmarks or equivalent ETFs, etc. The Syfe REIT Plus has done much better. So I think since inception, we are still 20% up from that standpoint, and most of the other REIT strategies are flat or even down. So I would say the REITs portfolio itself is managed very, very well. And we try to ensure that each of your dollar goes the longest. And the reinvestment of dividend, for example, is a huge feature. That itself adds 0.5% plus to your returns and pays for the management fee by itself, right? So these are things that are kind of like built-in optimization that you have in the REIT Plus portfolio. And that's the reason every year it outperforms the benchmark and the other ETFs in the market as well. So again, what I would say is, the performance as an asset class of REITs has been a little lackluster over the last few years. But I am again hoping that this time it is different, mainly because there is a clear pathway for interest rates to come down. And if economy holds up like it is holding up right now, my view is REITs as an asset class will see that uptrend, right? Because of that inverse correlation to interest rates. I'm new to Syfe REITs. Can you explain more on price to book ratio? How do you measure them? Richard, do you want to take this first? Then maybe I can add.
Okay, so price to book is that you will need to know the total in the investor relations of every REIT. You can go to their website, you can find the investor relations. Then you can see that they will give you various metrics. So you will divide the price by their NAV, right? So the net asset value, and that is how you get your price to book ratio. Now, looking at it alone, typically textbook will tell you that above 1 is overvalue, under 1 is undervalue. But you must never, ever make decisions based on that one number alone because it's above 1 or below 1. Because what is more important is that you need to see the trend. Because some solid REITs, resilient REITs like the one I showed you earlier, their price to book is never below 1. Never. So if you're only looking purely at price to book, you will never buy into that REIT. Okay, but I digress.
But it's an important point. I think you've
It is
captured it
important.
pretty well, that the fact is that don't look at price to book in isolation. Some REITs which have higher price to book, they command that premium valuation for a reason, right? And that's what Richard is trying to, explain. And there's the same case where, like, why people invest into the Magnificent Seven stocks, right? Why are their valuations just keep jumping and keep jumping? The reason is they have a very strong earnings growth. They are dominating every other stock in the S&P 500 because quarter over quarter, they just keep delivering on high earnings growth. This second half or Q2, all the Mag 7 stocks, not all the Mag 7, but like, and on an average, the Mag 7 stocks they delivered 26% earnings growth. They were supposed to deliver, 15% or 14%. They did 26%. The rest of the 493 stocks on the S&P 500, they did, I think much lesser, maybe 11%. No, sorry, 7% earnings growth. So the divergence is so high that investors are still putting money into the Mag 7 stocks, even though they are priced at, relatively very expensive valuations at this point of time. So just another, digression, but just giving you an example that not just one metric can suffice in your, reasoning of picking a REIT. So if you're looking to use this as the only measure to pick a REIT, we would say that look, at other factors as well. And there are many other. Okay, Ritesh said SG rates have to take this then, has delinked from US rates, and that S-REITs are driven by SG rates. How come US rate path is still the macro driver for S-REITs? This is a great question, and I didn't anticipate this question will be asked, but thank you for asking. So number one, yes, the SG rates has diverged and they have gone down. So from a standpoint of when you look things ahead, the actual rates that the Singapore government bonds will go down by will be lower, in my opinion, compared to the treasury yields that will go down. Now, there's also a difference of which rates are we talking about. This is talking about the 10-year Singapore rate versus the 10-year US Treasury rate. On the Singapore side, both the short-term rate and the long-term rates have come off. On the US side, the short-term rates will potentially get cut and will come down. They have, obviously remained at a, higher juncture. The long-term rates, which is the 10-year rate, has remained high as well, right? Now, from a US context, the 10-year potentially can remain where it is because there is fiscal concerns in the US. The short-term rates in the US is going to come down as we, anticipate the Fed to cut interest rates. What does it mean from a Singapore standpoint? If you look at the Singapore 10-year and the Singapore, short-term rates, which is measured as SORA, both those rates have, simultaneously come down. And if you again went and checked the, previous section where we covered the MAS policy, they have now come back with a more appreciation kind of like cycle, or not appreciation. They're going to maintain the Singapore dollar's appreciation cycle against other currencies, right? So the reason for you to still be looking at the US rate path for S-REITs is because over a longer duration, the US rates still dominate the macro conversations. And the reality is, as rates do come down in the US, the US dollar is going to weaken as well. And that will lead a lot of monies that go into outside investments will be potentially domestically invested as well. So if Singapore dollar is getting, higher compared to the US currency, that's number one. The rates, while it might not go down by the amount that the US rates will go down because the Singapore rates have already come down a bit, but the path is still down or maybe at the same level to a certain extent, which means that you are still looking at a low interest rate environment in the Singapore context. The macro global environment is, lower interest as well. In general, when it comes to borrowing, the borrowing of Singapore, REITs might also be not just, at the Singapore rate. That's also possible. So you have to take into context how the borrowing is done by the individual REITs. And that's the reason if you again, went back a few slides and you can go back during the, recording when we uploaded, you will see that the borrowing rate for the REITs are still to come down meaningfully, even though the short-term rates, SORA has come down, the long-term rates has come down, but the effect on the borrowing cost of Singapore REITs is still to come down. And that is going to come in time because most of the REITs do lock in their rates for some duration as well. So when they go back and they have to, recycle their loans, that's where you will see some of these effects come in much more prominently, right? So there is a lag effect to a certain extent. But again, the fact that interest rates are down, you will see that reflecting into the S-REITs as we move forward. Richaard, anything you want to add on that? All good, thank you. Okay, maybe the last question. We are at 7:41. Oh wow, there is still a lot of questions, is it?
Yes, Ritesh, maybe if you don't mind, I chime in here.
Sure.
Yeah, so I think for everyone who is still in this webinar here, do thank you for the questions. Because of the time
So these
constraint.
are all answered, by the way, right, Jason? Because we've answered all of these questions.
No, some of them we've not answered. In terms of like let's say from Cash Plus to REIT Plus portfolio. So I think these are some of the I would say more technical questions we've related to Syfe's platform. So,
Got
so
it.
what I just want to comment here before we wrap up this session itself, right, is some of these questions you can actually reach out to the client success team that is via the Syfe's mobile app and you can actually check in with the team. Right, so I know a few questions that are coming in are related to more of like promotion code. How do you actually input a promo code? What are the I would say the constraints of the promo code? If you're on one promo code, can you still apply this promo code? Right. So some of these questions, I would say you can actually reach out to the client success team, right? Or if you have a tech advisor to your account, you can also reach out to the tech advisor as well. Right. But in light of the time constraints, perhaps let me just pass the time back to Ritesh and Richard in a very quick summary. What is the one sentence takeaway that you would want all our participants here this evening to actually take away? Maybe Richard, maybe you go ahead first.
Okay. Yeah, I think the most important thing is always be diversified. If you are new, don't be a hero. Start off with a diversified portfolio using Syfe REIT Plus. Then you start to learn more about REITs investing before you venture into individual REITs.
Awesome. And I'll steal Richard's, words from previous, slides. The boat for REITs might be here, so please don't miss it.
All right. Thanks a lot, Richard, and thanks a lot, Ritesh, as well. With that, everyone, I do thank you for your participation this evening. Right. Again, if you have any questions, feel free to reach out to advisory or the client success team. Like what Richard mentioned earlier as well, the recording will be shared at a later date. All right. Thank you, everyone. Thanks for your participation this evening. Cheers.
Thank you. Thanks, Richard.
Cheers.